Pretty good?
Yep.
Yep. All right, let's call the meeting to order. Matt Covey, Pension Chair. Meeting's called to order at 10:06. Matt Covey, Pension Chair.
Jeff Wise, Citizen Rep.
Ethan Hearn. Mike Holycross, Investment Consultant.
Tom Lesnar, Citizen Rep.
Margaret Birch, Treasurer.
Kevin Kasiak, Police Rep.
I'd like to note on the minutes, excused absence for Tom Easchow.
So,
Looking for approval of the 2018 April 10th meeting.
move it.
Support.
All in favor?
Aye.
Approved. We have on the agenda approval for the bills. Is there,
I'll make a motion to approve the bills.
Second it.
all those in favor?
Aye.
Motion approved. We have a request for drop withdrawal.
And everybody's seen it, so I would do a motion for the approval of the drop withdrawal.
Second. All those in favor?
Aye.
Approved. Mike, you're up.
Excellent, thanks. You've got two pieces in front of you. One is our bound report. This is a Q1 report, so we're finally up and running. All the data in. This is the March 31st, 2018 report. So much like we went through the 12/31, we kind of just talk about general formatting and then any highlights within the report from a performance standpoint. If you look at page 12, this is kind of a good page to start. The first two pages, 10 and 11, have the overall allocation from December to March 31st. You can see any changes. And then the page 12 is a page that I like. At quick glance, it'll show you if you're in policy constraints or not. Right? If you're inside your investment policy, you're in compliance with your investment policy. So basically, anywhere you have a green diamond, you are inside your max and min constraints. Anywhere where you have a red, like on that international equity, we're just outside the 20% max. You see it's at 20.4%. So 314 doesn't mandate that you immediately take action. You got to sell something, right? We just want to identify. The markets could correct this in a second if the U.S. markets go up a little bit more than international markets. So we know we'll have a need for cash raise at some point in the next 2 to 3 months. And if this isn't self-corrected from the markets, you can then raise cash from the international equity portion.
Okay.
All right. So at first glance, quick glance, you can just see, whether you're overweight or underweight your target, because the target is the vertical line. And then if you have a green triangle, in compliance, red triangle, out of compliance. So we'll pay attention to that. We'll probably raise cash next month or the month after. Page 13 shows total fund return. I don't think we had this in the 12/31 reports. This is a new page 13. And I like it because of the cash flow. So if we look at gain loss summary on the quarter to date, beginning market value at the beginning of the quarter, net contributions, so net negative for the quarter, 2.1 million came out. Return on investment, so income and any gain or loss from the markets, $252,000, bringing your ending market value to $94.8 million for the March 31st time period. Bar charts are total fund return, but I think it's easier to read on pages 14 and 15 where we have the data versus your policy index, and then the median public fund within the public fund universe. So at the top, total fund for the quarter, 0.23%. So after all that market volatility we saw, right, we set new highs in January. We were off over 10% through the end of February. We just kind of treaded water for the rest of the quarter. Your fund finishes 0.23 positive. The median fund for the quarter, you see that your benchmark is down 93 basis points. The median fund finishes at negative 35 basis points. So obviously you still rank very, very well. A couple of standouts in terms of performance is going to be the Edgewood, as growth still dominated value in the first quarter. We'll probably start to see that come back in line for value. It's been a huge excess return for growth. So we will identify, if we want to rebalance into that, we can. We come down to under equities, all cap equities, see the WAM S&P 1500, so that's our index fund, small, mid, and large cap with World Asset Management. So you can see when you start to incorporate Small and mid-cap stocks and large cap stocks, negative territory for the quarter, 0.72% negative for all equities in the U.S. Hamlin, a little more interest rate sensitive in there. In the dividend paying portfolio, they finished down 1.99. They're still ahead of their Russell 3000 value. Sizer on the core portfolio, so here's the S&P 500, negative 76 basis points for the index. They were negative 64, so slightly ahead. And they're slightly behind for the 1 year, but ahead on a 2 and 3 and since inception. So equity markets in general, look at the S&P 500 down 76 basis points. That's the first negative quarter we've had in almost a year and a half. Been that long. And only second in the last 3 years. The markets have been definitely in a positive uptrend. Edgewood, as I mentioned, growth kind of dominated 6.53% versus value, which was in negative territory. Look at that next line down 2.98. Look at that return differential, just not only between the benchmarks, but what Edgewood did versus what your index fund did in the large cap value space. And we still have a slight overweight to large cap growth. That's the primary reason why you ended up in positive territory, even though equity markets were in slight negative territory. Reinhardt on the mid-cap side, so they struggled last year, just from a relative performance standpoint. If you remember, they underperformed by a couple percent. Just in a market that's going straight up, pretty typical for them to not perform in line with a positive 15 or 20% equity market. But look what happens when volatility returns to the market. They're up 1.27, their benchmark is down 2.50, so a pretty significant excess return in just 1 quarter. Clarkston, they put a little money to work, holding on to all that cash, and they've been in excess of 25% in cash. We've been kind of pinging them and making sure that we expect that they can't just sit on that much cash for a long time. They're in positive territory, 1.07% versus negative 24 basis points for their benchmark. HGK continued on their momentum from last year on the international side. They're in positive territory, 1.05, when the market's in negative territory again, negative 1.53. So if we were doing a up-down market capture, all these managers would be looking pretty good, right? Because you've got the markets in negative territory for the most part, and all of our active managers are in positive territory. Our index fund for international stocks, so it's really going to mirror what the EFA did, down 1 versus down 153. Emerging market stocks were in positive territory, 2.5%, the index 1.4. Fixed income, we got Loomis, Tips, and JP Morgan. So Loomis in negative territory, 66 basis points. As interest rates move up, we see some pressure on pricing for fixed income securities. They still outperform their benchmark. Tips down 88 basis points. JP Morgan in positive territory. So this little diversification tool we're using in a rising interest rate environment, JP Morgan did a good job. They're in positive territory, positive 28 basis points versus their benchmark down 141. Templeton slightly behind, 136 versus 250 for the quarter. So by and large, actually we got real estate on the next page, page 16. So real estate exposure. And some of this stuff outside of the American hasn't priced yet. So you'll see zeros for the quarter. So the rest of the data is all ending 12/31. So as it gets populated, we'll add it back to the total fund. So that total fund number can actually go up a little bit more because you're 5-6% in real estate that's not priced yet. And they should price into positive territory. So American, your core income, realty up 2.23% for the quarter, and the rest of it will price sometime in the next probably 30 days.
I'd like to make a comment. I think this board needs some kudos, and then Mike also for your hard work and dedication to this board. Look back 5 years ago, we were at 76 million. We've continued to pay pensions, and we're up over $18 million in 5 years. So I think that's pretty
substantial.
pretty awesome.
Yeah, market gains of almost 34 million.
Pretty amazing. Yeah, you figure out what we paid out plus what we're still sitting in the bank. It's pretty incredible.
Good work, Mike.
Yeah.
Good work, board.
Yeah. Glad we have you back, Mike.
Appreciate you guys. That's really it for the report. Just a quick summary on the managers. They've all done a great job in a volatile market. We're pretty happy about it.
What's your vision of the next couple quarters?
You know, Tom and I were talking about this before the meeting started. If you go through the first quarter earnings data, the S&P 500, they were coming in and raising estimates, corporations were, and they're still beating by over 10%. And they're saying that we think the rest of the year is going to raising expectations again. So I think once the market gets through some of this kind of headline risk, what Tom and I were kind of talking about, is it tariffs, is it a trade war, is it oil? When we get through some of this noise, we think we're going to end up in positive territory. The economic news is really, really strong. Leading indicators keep going up. There was a chart I had. It was a recession indicator. I found it on Thursday. Let me just find it real quick, and I'll read you the criteria. And all of them except for one were all in positive territory.
Really?
Meaning there was no fear in the immediate horizon of recessionary data or data rolling over for fear of economic slowdown or profitability slowdown. So we think we'll end up in positive territory.
You gotta think the North Korea, South Korea thing's kind of a little bit of
It's
a
not
positive note over there to.
Oil
Yeah.
sitting there bad, you know, and you got a couple other areas that just up in the air right now. I think it's
Yeah.
just an unsettled market.
Yeah. This recessionary indicator, the Credit Suisse put this out last week. So it goes back through the last 6 recessions. So November 73, January 80, July 81, July 90, March of 01, and December of 07. And then it says at the start of the recession, what are the indicators telling us? So the yield curve across the board in all those time periods was telling us we were you know, the 2 had inverted over the 10, so it was an inverted yield curve. That's usually troublesome for corporate financing, interest costs, things like that. It's harder for corporations to get things done, harder for banks. Inflation trends across the board, except for one time period, was negative. It was all recessionary indicating. Job creation, credit performance, ISM manufacturing, earnings quality, and then the housing market. So if you look at today's indicators, in the present, yield curve is still in positive territory, expansionary. The inflation trend is the only thing that's neutral. And that's what the Fed's been trying to do for 10 years, is trying to get some kind of inflation back into the system. And I think you'll start to see more and more of that. I mean, we're got almost 10 years, second largest economic expansion. That's the only thing that is neutral. Nothing indicates recessionary, everything else indicates expansionary. Job creation is still expansionary, credit performance is still expansionary, manufacturing is still expansionary, earnings quality and the housing market are all expanding.
Wow, that's good news.
Yeah. The market's gonna return to recognizing that, and once we get through some of this headline noise, and we'll be in positive territory. There's always unforeseen concerns, right? The unknowns.
You did get a size of capital quarterly report, but I think you already went over those numbers, so.
Right, that's their, their core portfolio.
They just sent everybody one.
I'd like to know how much money we returned from Sizer over the course of the time. And we're still sitting there at,
A good run.
Yeah, and we keep rebalancing.
we've taken money out of that so many times. and-
Which is
It almost
the
becomes
whole
a
idea.
bank.
This is why we stay invested in the equity markets long term, right? Over the weekend, you couldn't get away from any of the news on Buffett. You probably saw a bunch of that over the weekend, right?
Yeah.
He's still a long-term buyer of equities. He doesn't see a valuation bubble.
No.
He's been one of the greatest investors for 50 years. Size, let me see if I have cash flow numbers. You know what's not in here?
Every time I look at the numbers, it's just that. I'm trying to see it there.
Yeah, no cash flow in there.
Yeah, your predecessor, I think, wanted to push us out on.
Edgewood too.
Yeah.
The single page that got handed around has a blue bar across the
Yep,
top.
yep.
This I told you at the last meeting, we wanted to go through and just look at expense ratios. Now that we're back on board, all the data's transitioned into the database. Let's look at the mutual funds and ETFs, all of our kind of passive exposure. Mutual funds, we've got some active managers in there too. Let's just verify we've got the lowest fee share class. And there's a couple opportunities to lower expenses. So if you look at JP Morgan Strategic Income Fund 1, you see the ticker symbol there. current annual expense says 77 basis points. Does everyone see that number?
Yep.
Yeah.
If you go across to the right, there's another share class that has an annual expense of 54 basis points. So we can reduce by over $6,000 that $2.6 million investment. Same thing for Templeton Global, 68 to 52, just by looking at a different share class. And we've got notes on the far right on what we're actually recommending there, right? Change to a less expensive share class, change to a less expensive share class. Then we get to the Russell Value. We implemented with the IWD, the ETF. We can use the Vanguard Mutual Fund, which is less expensive, 20 basis points to 12. Same thing on the Vanguard developed VEA from 7 to 6. It's not a great cost savings, but it's still less expensive. The only one where we probably won't be able to do anything is on the emerging market area. VWO is at 14 basis points. We put in there just to let you know if we do get over $5 million investment, there is a Vanguard share class that would be 11. But the Admiral shares, VEMAX, on the far right in the notes section, you'll note is at 14 basis points, exactly the same as it is today. So there's no reason to do transactions for the same
Still pretty
price.
low number, 14.
Yeah.
14 basis points, yeah, pretty low. So all in all, we can save over $12,000 by just making these conversions. So if it makes sense to you, we're not changing any of the allocation, we're not changing any of the investment strategies. So we're just going from one share class to the next share class at a lower expensive option.
Has their performance been
It's identical.
identical
So
performance?
the JP Morgan income portfolios, it's the exact same portfolio, it's just a different share class in the mutual fund. There's no difference whatsoever.
Do you need a motion?
Just a motion to authorize that, and I can work with Comerica on getting this implemented.
So I'll make a motion to do the conversions. to the-
Second it.
All's in favor?
Aye.
Aye, motion approved. Great,
That's it for me.
thanks.
Yep, we'll have this implemented for the next meeting.
I'll save money.
Yeah.
Yeah. Other business, we received Maper's request from Tom Lesnar, it's an automatic approval. And then the distribution for American Realty, is that our last one from them?
No.
No.
That
No.
was,
Oh, that was,
Continental.
Continental.
Intercontinental.
Yeah,
There's no other business that needs to go in front of the board. Is there a motion?
to adjourn?
Second.
All's in favor?
Aye.
Aye.
Meeting adjourned at 10:24.